All right, guys. Welcome to this wonderful lesson. Today we are going to be talking about how to differentiate between break of structure and liquidity sweep. Is that clear? So I'm going to split this class into two sections. I don't want it to be too boring. So the first class we are going to talk about um, liquidity and break of structure. Initially, if you check my channel, I've already made a video regarding market structure or break of structure and also on liquidity. So today now, I'm just going to be explaining how you can differentiate between break of structure and liquidity sweep, because this is a big problem many new traders are having. So they can't identify when there's a liquidity sweep and when there's a break of structure. So it's more or less very confusing to them. So I would love you to pay attention so that you'll be able to get the best in this very class. So I'm going in the first part, I'm going to talk about we are going to just talk about the theoretical aspect. While in the second part, we are going to we are going to be talking about how we can identify them on a real life chart. Exactly. Probably you are watching my video for the first time on this channel and you have been having issues with how to trade the forex market and the synthetic indices. All you need is a mentorship guide. So currently I'm going to be doing 60 days mini mentorship class, and you can chat me on my WhatsApp number so that you can be part of the class. Is that clear? Because in that class I'm going to be teaching you both the theoretical aspect and the practical aspect. Once you pay, I'm going to send some materials to you. Those materials are just to make the teaching um quick. That means you understand the teaching very fast, right? Then there are also videos I'm going to give you. Not only that, I'm going to add you to my WhatsApp community. In this WhatsApp community, we can be talking about trades that are currently on, how you can analyze charts. So, and aside that, you can even, and with whichever part of the lectures you are finding difficult, you can easily relate with me. Then we'll both I'll explain to you, then tell you the necessary things to do. So I believe by this approach, in a short time, you notice that all the issues you have been having and all those losses you have been experienced all will come to an end. Is that clear? So don't hesitate to chat me up on my WhatsApp number. You can check the description below. You also see to confirm the number, and then you get in. So that means let's get started. Now, understanding market structure and liquidity sweep is a very great uh, lesson or concept you shouldn't avoid, because these two concepts are major concepts when you are starting the forex market as a beginner. So when you understand your structure, it is also important to understand liquidity so that you don't miss liquidity for structure, break of structure. So let's start with the writing materials before you. You can take your time to probably pick one or two things down with your pen. Understanding the difference between break in market structure and liquidity sweep in forex market or forex trading. Forex trading involves various technical concepts that traders use to understand market dynamics and improve their decision making. Two important concepts are break in market structure, which is the break BMS, and liquidity sweep. While both relate to price action and market behavior, they serve distinct purpose in analyzing the forex market. Let's explore the concept in details to highlight their difference and applications. The first question is, what is break in market structure? If you have watched the previous video, uh, all this is just more or less like a recap of what I've made in the concept market understanding the ultimate guide to market structure. Is that clear? A break in market structure occur when the price action shifts the prevailing trend by evaluating key levels of support or resistance. What some traders take support or resistance to be is a single line, or let's say an horizontal line, right? They believe when price get to a certain level like this, where price move and couldn't break above this point, then they place the horizontal line on it. So that is what they see as resistance. Then when price drops and fail to break this point so easily, That is what they see as support. Right, you are right, but when you go deeper into the forex market, it's more support and resistance is not just an horizontal line in the chart, it's a zone in the chart. Exactly. It's a zone in the chart. And when we are talking of support level and resistance level, instance, let's say for instance, price is making a, a bullish move, make a pullback. This point where price got to and fail to move up or rather start dropping, which is the pullback, can also be seen or referred to as area of resistance. Exactly. It can be a certain key level, a random number in the chart which prices are reacting to. But being the fact that the momentum is towards the upside or the momentum is for bullish move, definitely that area won't hold price for too long. The next time price will be coming to that point, price is definitely going to break through. That is in the case of a buy. Then in the case of sell, where price is dropping, let's say price is dropping from the upside, right? And it got to a point in your chart, it started making pullback, right? This pullback is making at this point, this area here is just telling you that price is at area of support. That support level might just be a partial support. The next thing you're going to see, since the momentum is towards the downside, price is going to break that support and move below. So when you hear areas of key level, it's just talking about areas where price react to. It can be a support and resistance level. It can be a random number on your chart. Exactly. It can also be area of supply and demand. So whichever case it may be, you ought to understand that when price breaks above that point, either up or down, then there is what we call break in the market structure. Now, when you go deep or when you watch that video to the end, we also talk about understanding a continual trend and a reversal trend in market structure. That means when the price is in a continual phase, what you should see, and when the price is on a reversal phase, what you should expect and what you should see, and how you should approach it as a new trader. So if you've not watched that video, it will be very important to go and watch the first video regarding market structure and then liquidity in general. So moving further, this signifies a potential reversal or continuation of a trend depending on the context. Key characteristics of a break of market structure. First one, in the definition, a BMS happens when market breaks a previous swing high in an uptrend or a previous swing low in a downtrend. So these are just more or less like repeating what we've done in the first class. But it's very important. Probably this is the first video you're watching, then it means you need to go and watch other ones so that everything can make more sense. Then number two, indicates a change in trend. A break suggests that the market might be uh, transitioning from bullish to bearish. All these are already the first video. Number three, trader's perspective. This is often interpreted as a sign to adjust trading positions based on the potential new trend. That means if let's say price is moving upward, and all of a sudden you notice a kind of reversal where price has broken above your lower high, then it is a signal for you to, if you have been taking, if you have been on that trade, it's a signal for you to exit or a signal for you to get ready for the next move in the change. So these are the characteristics we can see. Then example of a break of market structure. In an uptrend, break of market structure occurs when the price fails to create a new higher high and instead break below the most recent higher low. What this implies is that it's just talking about the reversal phase of price. In a bullish trend, when price moves up, right? Price gives you all these moves towards the upside. Now you're expecting price to give you a new high because that is what has been happening. But rather, price failed and break this previous higher low. That is what that um, context is talking all about. In a downtrend, A BMS occurs when the price breaks above the most recent lower high, signaling a potential reversal. That is, in a downtrend when price is coming down, giving you higher lows, right, and lower lows. So the next move towards the upside is for price to probably come down, then rather it breaks above the higher, the lower high, right? Then it's indicating that price is giving a bullish kind of reversal. Now, trend implications. What are the implications of all these things? Confirmation of trend change. Traders often wait for a retest of the breaking level to confirm the validity of the break. That is why when you watch that video, I told you that let's say price is moving towards the upside, right? Price is moving towards the upside. Now, the fact that price came to take out this higher low is not a guarantee for you to just place a sell immediately. Now, the first confirmation we want to see is price coming back, failing to break above this high. That is one. Then, secondly, price taking out this low. Immediately, price takes out this low, then we are now interested in this area because our next plan is when price come up to that zone, then we are shooting our shot towards the downside. Because first we have a confirmation, a change of character. Secondly, we notice a BOS because and the BOS, the price that led to the break of structure couldn't break above the high. So that is what this trend implication is talking about, that you should get what? A confirmation. Confirmation that the trend has indeed changed or reversed from a bullish to bearish or a bearish to bullish. Entry and exit points. Break of market structure can provide strategic points for entering trades or exiting um, trades. Then risk management. Stops can be placed just beyond the broken level to limit losses. Exactly. So these are just the implications of what we get. Then coming down to liquidity, what is liquidity sweep? A liquidity sweep refers to the market's action of targeting areas with a concentration of stop losses order or pending order. This area typically exists around swing highs, swing lows, or psychological level. Liquidity sweep are often driven by institutional players seeking to execute large orders. Now, the secret of this is most especially for those the key players, the market makers. Whenever they want to make a decision or they want to place an order in the market, they go after those areas where you are putting your stop limit, your stop losses. Is that clear? Where you're putting either your buy limit, your sell limit, your stop loss, they will go there, trigger your stop loss, then use that move to create a reversal in the market. So when you don't understand market structure and you don't understand liquidity, this is when you fall into this trap and then you'll be used as part of the liquidity. The characteristics of liquidity sweep. A liquidity sweep happens when the market temporarily spikes through a key level, e.g. a support or a resistance zone, to trigger stop losses or pending orders. What is the purpose? The market seeks to grab liquidity needed to fuel further moves. Transcend nature. Sweep often result in sharp reversal as the liquidity is absorbed. Yes, when we get to the part B, all these things will be more clear, but you just need to understand so that it doesn't look like we jump into the chart and we don't have uh, a kind of prepared mindset. Examples of liquidity sweep. At a swing high, the price breaches a prior high, triggering stop losses order for sellers only to reverse downward afterward. At a swing low, the price dips below a previous low, triggering stop losses order for buyers before reversing upward. All these things I've explained it in the liquidity uh, concept guide. So don't fail to watch that video so that all these things will make more meaning to you. Trading implication, trap and reversal. Liquidity sweep often create false breakouts, trapping traders on the wrong side of the market. Entry opportunities. Traders can use sweep as entry points, anticipating a reversal once liquidity is collected. Patience and timing. Waiting for confirmation after sweep is crucial to avoid falling victim to the false breakout. Is that clear? This brings me to what I keep telling you, that when price is making moves towards the upside, right? Price is breaking structure towards the upside. Now, the moment price breaks below this point here, the reason why I said it's not a confirmation for you to take a sell immediately, this can be a liquidity sweep. The only way we can confirm that true this is not a liquidity sweep is when price fails to break above the high and then breaks below the previous low. Then we confirm, okay, this move that came to take out this higher low is not a liquidity sweep. Because there's an instance price can give you such move. Are you getting it now? Price can give you such move. You are expecting price to come down. Price will just come, break here, right? If you don't understand liquidity sweep and you don't understand market structure, you start pushing orders immediately, or you even come as far as putting sell limit here. That when price come to that place, it will mitigate it, then it will go down. The next thing you're going to see is price will just come and break, take you out, plus your stop losses and everything. Price will just push you out, and then it will create what we call a breaker block around that zone, right? So once price will just do, price can just come for confirmation, test it, then it will start pushing towards the upside. So you have to wait for confirmation before you place your order. Is that clear? So this is the reason why some people don't like placing sell limits, because when they think price has finished clearing liquidity, they don't know that price is just starting. So as a trader, you need to be very patient so that you don't be a victim of such circumstance. Then number three, comparing break in market structure and liquidity sweep. So let us just do one or two comparison. In the definition, a structure change the market trend through key level valuation. Is that clear? What this implies is that if it is going to be a break of structure, price that breaks above the previous higher low, right? Price that breaks above the previous higher low will not come back to break above this high, which is at the point at the top here. Rather, what price is going to do is price is going to come back to some point, then break the low. This is going to be a serious confirmation that we have a break of structure. But in the case of liquidity sweep, there's going to be a different approach to that. A temporary breach of a level to collect liquidity. So in the case of liquidity, this is what you're going to see: price moving up, right? Price moving towards the upside. And the next thing you notice is price just come close below this point, and you are expecting it to just give you a kind of pullback, then start going down. What you see next, price will just break above here, and then make here an area of uh other breaker block, taps in, then continue the move. You see that this sharp move here now is not what? It's not a break of structure. So it is just telling you that it came to take out, let's say, liquidity around this point for it to gain momentum towards the upside. So these are what you should know about this concept very well. Then two, purpose signals potential trend reversal or continuation. In the BMS or BOS, when we have such, price automatically change uh movement or trend if it is in a reversal situation. Then if it's in a continuation situation, price keeps giving you higher highs or lower lows. But if it is based on liquidity sweep, price is going to provide liquidity sweep for institutional players to execute large order. That means it will just make the institutional player to, after taking out all the stop losses, now it gives them room to place their orders in the market. Why in the market structure it gives you a signal for continuation or reversal. Now, behavior. typically leads to a sustained move in the direction of the break, right? Once there's a break in market structure, then it gives you a typically uh sustained move towards that direction, either if it is upside or a downside. While in liquidity sweep often results in a sharp reversal after triggering liquidity. So it doesn't continue. It's not sustainable. That break is not sustainable. It's just a sharp move and then it's continue with a normal trend or an opposite trend. Why for time frame seen across all time frame, most significant on higher time frames, can occur on any time frame. So this are what they have in similarities. It can happen both in your lower time frame or in your higher time frame. But for the break of structure, we always focus more on the higher time frame because when price break structure in the higher time frame, it tends to hold more ground compared to our lower time frame. Then traders response, adjust position to align with the new trend. That means if it's a case of reversal trend, what you should do is you adjust. Probably if you are in a buy position, then price breaks the higher low. What you have to do is to close your higher low orders and then wait for price to give you a move towards the new trend, which is the downtrend. While you take your entry. Why if it is in a liquidity sweep, wait for confirmation and trade in the opposite direction of the sweep. That means if price should go above you are taking sell, then price you are taking buy. So you are waiting for sell. Price went above, clear liquidity and face the downside. You should take the reversal because the move that went to clear liquidity can either be a buy side liquidity or sell side. All these I've also explained it in the liquidity class. So try as much as possible to watch that video so that you can be able to get everything clearly. Now the risk involved, risk of false break, that means there could be a risk of false break in market structure. While in the area of liquidity, risk of misinterpreting a sweep as a genuine breakout. You can see it now. This is where most people are being trapped because they don't understand market structure, and at the end of the day, they get trapped with this kind of situation. Then number four, what are the practical application in forex trading to all these areas? Using the break of market structure, use it to identify key level, determine a swing high or swing low as a potential break of structure zone. Two, monitor volume and momentum. Higher volume often validates a BMS. Exactly. When you listen or when you watch the last video regarding market structure, they said if what validates your structure is if the body of the candle closes with a momentum above the previous high. So that is what validated. This is the same thing that is being repeated here. That if the momentum is very high, that means it has validated that there's a break of structure. Then the third one is to wait for confirmation, retest, strengthen the reliability of the confirmation. That means when price break structure, probably you expect it to come back to the zone where the structure has been broken before you start taking your entry, which can be seen as either a discount area or a premium area. Then going deeper to using liquidity sweep, spot liquidity zone looks for areas with likely concentration of stop orders. This in the previous class on liquidity, we talked about areas where we should be expecting liquidity. Areas like the high of the day, the low of the day, high of the week, low of the week, high of the month, low of the month, equal high, equal low. Uh, Many other areas where you should be expecting liquidity to be, so that when price is giving you a kind of move at those areas, you should be able to tell if this is a liquidity move or any other move in general. Then two, watch for reversals. Sharp spike followed by quick reversal often indicate liquidity sweep. Is that clear? When you notice a quick reversal, then it indicates a liquidity sweep. Combine with other tools using additional confirmation signals such as candlesticks pattern or volume spikes. So this brings us to the end of the theoretical aspect, just to give you an insight. Probably this is your first time coming across this video, but if this is your first time, get informed that we have made videos regarding this topic in a separate form. That means on break of market structure and on liquidity. So you need to digest the two information so that whenever you are reading here that prompt us to talk about the differences between these both should make more meaning to you. When you check the list, you will notice that there are videos there for you to watch on these two topics for you to make it for you to get it clearly. Then if you are still not clear, then you need probably deep explanation. Then what you need is mentorship. Don't hesitate to join the mentorship class. This is the number here. You can chat me up, either you're a synthetic trader or uh, a forex trader. Exactly. So now please watch out for the part B, where we are going to be talking about the practical aspect, where you are going to see all these things explained here in a real life chart, so that you can be able to identify them when you approach your chart next time. Thanks for watching. Make sure you watch the part B of this video.